You can learn every option strategy in the book: puts, calls, spreads, condors. But if you don't understand the Greeks, you're flying blind. The Greeks tell you how your position will behave when things change, when the stock moves, when time passes, when volatility shifts. They're the dashboard behind every trade. And once you understand them, options stop feeling random and start feeling predictable. Let's go through each one. Delta measures how much an option's price changes when the stock moves $1. A call option with a delta of 0.50 will gain roughly 50 cents if the stock moves up $1. A put option with a delta of minus 0.50 will gain roughly 50 cents if the stock drops $1. Think of delta as your directional exposure. The higher the delta, the more your option behaves like the stock itself. An option deep in the money, with a delta near 1.0, moves almost dollar for dollar with the stock. An option far out of the money, with a delta near 0.05, barely moves at all. But here's the practical insight most traders use. Delta approximates the probability that the option will expire in the money. A 0.30 delta means roughly a 30% chance of finishing in the money. A 0.70 delta means about a 70% chance. This is why delta matters for income sellers. When you sell a cash-secured put with a 0.20 delta, you're choosing a strike that has about an 80% probability of expiring worthless. That's how you engineer the odds in your favor. For your portfolio as a whole, delta tells you your net directional bias. If you're selling puts and your total portfolio delta is strongly positive, you have significant upside exposure. If the market drops, you feel it. Knowing this lets you balance your positions. Theta measures how much value an option loses per day just from the passage of time. It's also called time decay. If an option has a theta of minus 0.05 cents, it loses 5 cents of value each day, all else being equal. For option sellers, this is your best friend. Every day the market is open, time is eroding the value of the options you sold. That erosion is money moving from the buyer to you. Here's the key. Theta doesn't decay at a constant rate. It accelerates as expiration approaches. An option with 60 days to expiration might lose $2 of value per day. That same option with 15 days left might lose $8 per day. And in the final week, the decay can be dramatic. This is why the 30 to 45-day sweet spot exists for selling options. You enter when theta decay is starting to accelerate, but before gamma risk becomes too high, which we'll cover in a moment. For income strategies like credit spreads, iron condors, and cash-secured puts, theta is the engine of your profit. Every quiet, uneventful day is a day where theta works in your favor. Gamma measures how fast delta changes when the stock moves. It's the rate of change of the rate of change, like acceleration in physics. Why does this matter? Because delta is not static. As the stock price moves, your option's delta shifts. Gamma tells you how much. For option buyers, gamma is beneficial. It means their delta increases as the trade moves in their favor. Their profits accelerate. For option sellers, gamma is a risk. It means that as the stock moves against you, your delta increases. Your losses accelerate. This is especially dangerous near expiration when gamma spikes. Think of it this way. If you sold a put with a 0.20 delta and 2 weeks to go, a $1 move against you might increase your delta to 0.25. Manageable. But if you're 2 days from expiration and the stock approaches your strike, that same $1 move might spike your delta to 0.60 or higher. Suddenly, the position is moving against you much faster. This is why experienced sellers often close positions before the final week. Theta decay is nice, but gamma risk in the final days can wipe out weeks of slow, steady profit in a single move. The practical rule: respect gamma. Don't hold short options into expiration just to squeeze out the last few cents of premium. It's rarely worth the risk. Vega measures how much an option's price changes for a 1-point change in implied volatility. Implied volatility is the market's expectation of how much a stock will move in the future. When uncertainty is high, before earnings, during geopolitical events, in a market sell-off, implied volatility rises. When things are calm, it falls. If an option has a Vega of 10 cents, and implied volatility increases by 1 point, the option gains 10 cents of value. If IV drops by 1 point, it loses 10 cents. For sellers, falling volatility is profitable. You sell options when IV is elevated and when it contracts, the options you sold lose value, which means you can buy them back for less or let them expire worthless faster. For buyers, rising volatility helps. Even if the stock doesn't move, an increase in IV can make your option more valuable. This is why IV rank and IV percentile matter when choosing trades. If IV rank is above 30 or 40, meaning current IV is higher than it's been for much of the past year, conditions are favorable for selling strategies. Credit spreads, iron condors, and cash-secured puts all benefit from entering during elevated IV and profiting as it contracts. After earnings is a classic Vega play. I4 builds up heading into the announcement and collapses afterward, the so-called IV crush. Sellers who position before earnings can profit handsomely from this crush, though the directional risk is real. Rho measures how the option price changes with a 1-point change in interest rates. Honestly, for most retail traders, Rho is the least impactful Greek in day-to-day trading. Higher interest rates slightly increase call prices and slightly decrease put prices. But unless you're trading very long-dated options, leaps with a year or more to expiration, Rho's impact is minimal compared to Delta, Theta, Gamma, and Vega. Worth knowing, not worth losing sleep over for most positions. Here's where it all clicks. When you sell a credit spread, you want Theta working for you, time decay generating profit, low Gamma, reduced risk of sudden Delta shifts, and Vega working for you, volatility contraction reducing option values. When you buy an option for a directional trade, you want high Delta, strong directional exposure, low Theta drain, enough time for the trade to work, and positive Gamma, profits accelerate as the move continues. The Greeks aren't separate dials you tune independently. They interact. High Gamma environments tend to coincide with high Theta. Elevated Vega comes with wider expected ranges. Experienced traders don't just look at one Greek, they assess the full dashboard. Before entering a trade, they ask, what is my Delta exposure? How much Theta am I collecting or paying? How sensitive is this to a volatility change? And how much Gamma risk am I taking on? That holistic view is what separates strategy from speculation. Delta is your direction. Theta is time working for or against you. Gamma is how quickly things can change. Vega is the volatility impact. Rho is interest rates, mostly in the background. For income sellers, Theta and Vega are your allies. Gamma is your risk, especially near expiration. For directional buyers, Delta and Gamma are your accelerators. Theta is your cost of doing business. Understand the Greeks, and you understand why your trades behave the way they do. No more surprises. No more confusion when a position moves in unexpected ways. This is foundational knowledge. Everything else builds on it. Subscribe if this helped. More to come. See you in the